A very good morning, good afternoon, good evening, warriors. I hope you're all doing well. Uh, just wanted to come forward and discuss the paper because, a very happy news for everyone. I think this time's paper 4 was quite easy, whether it is DT or IDT. So I think a lot of jolly faces I noticed, and I thought it's the best time to come and discuss with you all how the papers were, what exactly were the answers to the papers, and then give you an hindsight on how it's going. So yeah, we are going to jump into this paper very quickly, but I think before I get into it, I did notice a few other papers also did not go so well. I heard some comments about accounts, I heard some comments about costing, and on the other hand, DT was very easy, the IDT was very easy. My overall recommendation would be don't worry about it so much, because at the end of the day, it's CA. It's not that every paper will come easy, and that's how the rule of life is. And it doesn't at the end of the day mean that you're not going to pass just because of one paper and you're going to fail because of one paper. I think ICA takes care of everyone on a standard basis. If you have justified your position, I think that should do well for you. And at the end of the day, like I say, everyone, no, it's not about whether you pass or fail in this attempt. While it's definitely important, it's more about you getting satisfied with your performance, because that is when you push yourself for the next time, even if it doesn't go well. So don't worry about it so much. Keeping that mindset is what I'm going to discuss this paper for. What we're going to do is we're going to look into our paper. We're going to understand all the kind of adjustments which came, and then we are going to solve the adjustments also. While I may not be doing the answers as such, I may not be giving you the final numbers, but I would just give you a hindsight on how this provision will work. Before I start, two rules. Rule number one, this video is absolutely not for everyone who's attempting group 2 right now. If you are attempting group 2, please stop watching the video right away and start studying for your syllabus. This is not the time to do it. Complete your paper and then come back, and then we will discuss about it. Rule number two, everyone who has already completed their exams, who's looking at this video right now, if you have attempted this paper, don't get frustrated if something goes wrong. Please understand, people, the paper was easy, but that said, there are some tricky adjustments here and there, which you may not have understood on the plain side, and that's what I am here for. My intention is very simple. I want to give you an understanding of how the paper looked like, what and all are the adjustments which you probably have missed, and so you'll be careful for your future life. I'm not saying next attempt, but probably your future life. So keep that in mind. Do not get frustrated about what you have done. Don't start retrospectively introspecting your chapter and tell that I was expecting 90 after Rahul's video, I'm expecting only 60, 40s and all. Don't worry about it. You've already given your paper, the fate is already sealed, so you will get your answer as it is possible. So don't worry about it. My intention with this syllabus is only to clarify to you that there are some things which you might have missed out, and also keep this for your November students and for the upcoming batches. So everyone who's attempting November or upcoming batches, if you're planning to write this paper as a practice paper, you can probably use this video as a guidance video for you to understand what exactly are you going wrong. That's the sole intention of the video. No intentions of making anyone derailed, making anyone upset or anything about it. So please do not have that mindset, and don't watch the video with that kind of noises, because otherwise you will not enjoy the video as such. Yes, keeping that in mind, my expertise is in direct tax, so I'm going to give you the direct tax kind of analysis. The indirect taxes is something which I probably would assume that the other faculties will take care of, so my supervision comes into the direct taxes. And unfortunately, since ICA does not release the MCQs, I don't have that to discuss with you. I only have the full-fledged questions, so I'll be discussing the 42 marks worth of syllabus which is given in your, 42 marks worth of questions which are given in your paper, along with the extra question which was also given. An initial impression on the paper, honestly, yes, it's a very easy paper which I found this time. There were no tricky adjustments this time. Normally speaking, direct taxes, you would have some out of syllabus questions coming in, some questions from the smallest of the chapters coming in, but unfortunately it did not end up that way. You had a lot of known syllabus coming in, a lot of 1 mark adjustments coming in for 4 marks, 7 marks, and also there was a lot of time available for you to complete a paper. So very I would say I wouldn't call it average, also probably an easy paper, subject to some adjustments, obviously, that is always there with their indirect taxes. Beyond that, I think it was a very easy paper which anyone could have cleared, irrespective of whether you did a class or not. For someone who have done it beautifully well, I think you can easily score an exemption, could actually score more than 80 plus also if you have done your IDT also properly. So that's my initial impression. But why is it so? How is it so? We are going to discuss in this paper. So let's quickly dive into it without wasting any further time. Yes, I have the paper in my hand. I have downloaded from one of the Telegram channels who had it available. So a lot of markings here and there would be visible. So please ignore all those. Focus on my understanding, and I think that should do the purpose. Starting with part number A, the section number A. This was a full-fledged question, came for about 14 marks. And a very standard simple PGBP along with some few other heads income. So let's read the question and let's understand the approach, how it should be done normally in an exam atmosphere. You look at the question and it says, you're Mr. Bhasan, A resident individual who's aged 52 years is providing management consultancy services to various corporates and non-corporates clients. Now, on the first impression, two things to note. One is that you are aged 52 years, which means you are a non-senior citizen, which means your basic exemption limit will start with 2,50,000 if at all the question asks you for a tax liability. And there are some other adjustments here and there which we'll keep in mind, but as such the age is 52 years, which is what is to be kept in mind. Second thing which they've come and said is that you're providing management and consultancy services. With you providing management and consultancy services, it technically means that you're a professional. Now, why I'm telling you this right now is that because if you have noticed that it's a management and professional technical services, first of all, you're not into manufacturing sector, which means additional depreciation nonsense is not available to you. Second, since you're into a business of you're into a profession, you are now supposed to check for something called as presumptive taxation also, unless the question asks you otherwise. So imagining the question is asking for presumptive taxation, this will something which will help you. So keep a note of that. You have to look at your management consultancy charges as your presumptive taxation taxable under 44 ADA if at all no other provisions are given. Keeping that in mind, let's understand the question paper. It says that you have an income and expenditure account given to you for 31st March 2023. Now, I would have told my students always to start from the right side, so I'm going to follow the same approach. I'm going to start from the right side. Starting from the right side, it comes and says that you have an income by a gross receipts of profession. The last year turnover was, gross receipts were 75 lakhs and no TDS was deducted last year for the clients. Now, this is a weird adjustment given in the paper. For some reason, while the turnover is 75 lakhs, you are required to deduct TDS, but for some reason they have decided to inform you that no TDS has been deducted. Now, first impression in my paper, I don't know. Should I look at every line item in my expenses side and say that, boss, this expenses should have been liable for TDS and therefore you forgot to do it, so it disallowed? Or you should wait for an additional adjustment? The first question which came up in my mind, something which is very weirdly put here, but okay. Let's link about it later. As of now, it comes and says that the last year's turnover is 75 lakhs and the current year's turnover is 60 lakhs. Now, with last year's turnover being 75 lakhs, you are liable for TDS on almost every case. But that's not the point. The point is the current year's turnover is more than 60 lakhs. Now, with the current year turnover being more than 60 lakhs, your 44 ADA goes out of picture. The 44 ADA provisions only apply when you are 50 lakhs and below. In this case, since it is 60 lakhs, you don't have to worry about 44 ADA also, meaning you need to do a standard simple PGBP. Easy part. Next part, they come and say that you have an interest on savings account, which is about 25,000 rupees. Now, what will happen with this is that this will automatically move to other sources. So what you need to do is you need to reduce it from your PGBP and you need to move it to your other sources. Now, for those who did it till this much, good. You might have missed out one other thing. Since it is interest on savings account, you're also eligible for something called as ATTTA. You're also eligible for ATTTA with an amount of 10,000 rupees. If at all the question is asking you for total income, which my impression is, but if you have missed it out, yes, you might lose half or 1 mark in this. The next one, it comes and says that you have a winnings from lottery. The net of the cost of the lottery tickets is 500 rupees. So what they're coming and saying is they have basically booked their P&L itself in such a way that the amount which is showing on the screen is only net of costs. Now, unfortunately, first of all, there is an accounting mistake because you cannot show your expenses net of income. That's a weird assumption to make. But anyways, since it is ICI, let's adhere to it. First of all, because it is winnings, you will have to move it out of your PGBP. Now, what you need to move out of your PGBP is the amount which is showing here, which is exactly 99,500. But when you go to other sources and you start taxing this winnings, you have to remember the fact that when it comes to winnings, income tax does not permit any kind of expenses claim, which means when you're going into winnings, you have to offer the whole 1 lakh rupees. Now, you might ask me, Rahul, why are you only reducing 99,500 from PGBP? Then you should have reduced 1 lakh. When the amount itself is 99,500 PGBP, that is what you can reduce. You cannot do anything beyond that. And so 99,500 is what you're reducing from a PGBP. 1 lakh is what you're going to offer as your IFOS income. The next thing is your rent received. Now, 2,40,000 is worth of your rent received. With nothing given, I would assume that this is rent from an house property. And so I'm going to move it to HP, which means I need to reduce it from my PGBP. And I need to offer it to my IFHP. At this impression, I'm going to keep it as IFHP. I don't know what the head looks like. So I'm going to keep it at IFHP. If at all the adjustment changes later, we'll come back and revisit this. Coming to the left side, you have something called as employees remuneration, which is about 15 lakh rupees. Total office and administrative expenses is given as 5 lakh rupees. Rates and taxes is given as 15,000 rupees. Interest expenses is given as 80,000 rupees and office rent is given as 2,40,000 rupees. Insurance premium is 72,000. Professional fees is 2 lakhs. Depreciation on computers is given to you as 1,20,000. I'm going to highlight this and keep because you might have noticed already that when it comes to income tax is not a big fan of the depreciation which is done as per books of accounts. I have not been clarified until date whether it is depreciation as per books or depreciation as per income tax. So I'm going to highlight it and keep. In case I find out later that it is depreciation as per books, I'm going to disallow it and I'm going to reduce my income tax depreciation. As of now, I'm going to leave it as is. This is my income over expenditure, which means this becomes my net profit. With this becomes my net profit. With this much information in hand, let's quickly prepare our extract of PGBP also, just to be careful about it. We are going to look at my PGBP income. My PGBP starts with my net profit. So I'm going to bring in my net profit, which is 36,97,500. With whatever we have learned from the table right now, let's make those changes. With my net profit being so, I'm going to first start from the right side, which means I'm going to reduce whatever items I am not required under PGBP. The first item being my savings account, which is about 25,000. The second item being my winnings. Now I told you need to only reduce the amount which is showing on the screen, which is 99,500. So I'm going to reduce the same amount. I'm going to add my rent, which is, I'm going to remove my rent, which is 2,40,000 rupees. Which is 2,40,000 rupees, and that's it from the right side. Coming to the left side, I have some expenses to disallow, but nothing has been clarified to me right now, so I'm not going to disallow any expenses. I'm going to leave it as it is. Going to the next part of the question, we have some additional information which is pretty obvious. It comes and says that the employee's remuneration includes a sum of 3 lakh rupees which is paid to his wife, Mrs. Beena, who is working as a manager in his office. She does not have any technical or professional qualification or experience required for the job, and the payment of salary was as per the market rates and compared to the similar work profile. Now, here is where they played smart with you and you got caught in a trap, because if you look at the last line item, the last line comes and says that the market value is the same of the price, which means what salary you have given to your wife is the same as what you are expecting out of the market, which means anyone joining from the market would have also got this salary. So therefore, provisions of 40A2 will not apply. The provisions of 40A2 will not apply, which means there is nothing to disallow. There is nothing to disallow and you're pretty much safe on those. But the hidden adjustment here is that they have somewhere come and clarified that there is a professional and technical qualification imbalance, which means she does not have the professional and technical qualification and she is your spouse. With that happening, what happens is your PGBP does not get impacted, but actually comes in your clubbing provisions. So which means whatever salary was received by your wife, because you do not have any professional or technical qualification, will now be clubbed in your hands under the head salaries. So which means while PGBP does not get impacted, you will have to create a new head of income right now, which will be called as salaries. So you create a new head of income called salaries. Now the question comes and says that she has received 3 lakh worth of salary. Now when you have received 3 lakh worth of salary, it simply means that the standard deduction is not granted to you, and so you will have to grant the standard deduction also before you offer something to taxes. So you will grant your standard deduction of 50,000 rupees and the income to be offered to tax will become 2,50,000. This will become taxable in your hands because she is working in your firm where you have a substantial interest and she does not have any technical qualifications. Completed till here, let's go back to the next question. They come and say that you have Mr. Basin owns a big house with 2 independent units. The unit 1 is 50 floor area, has been let out for residential house at a monthly rent of 20,000 for the year. Now this impacts your P&L. If you notice your P&L, we had something called 2,40,000 rupees worth of rent received. Now I did not know what property it is. They have clarified it in point number 2. The point number 2 comes and clarifies to you that it is a property where 50% of it is let out for residential purposes, and therefore 2,40,000 worth of rent which is showing here should be offered to tax under the head HP. So which means the 2,40,000 which you showed as a removal from your PGBP now becomes a part of your HP. I'm sorry for the commotion, sorry for the mishap happening, so I'm going to put it on the right side somewhere so that becomes clarified. It is 2,40,000 worth of actual rent which has come as taxable under HP. Yeah, let's move forward. Moving forward, it comes and says that this 2,40,000 is only pertaining to 50% of the property, and the balance 50% of the property is utilized by Mr. Basin as his residence cum office, which means this property is a self-occupied property along with the PGBP property. Now ideally speaking, since it's a PGBP property also, I would have preferred to charge depreciation on that property, but unfortunately the question does not give any information, so I would not have any depreciation numbers to charge, which means I'm safe on those terms. I just have a SOP property in my hand. The municipal valuation is given to you and the fair rent valuation given to you along with the standard rent. Now please do understand these values given to you is for the full property, but you only need it for 50% of the property because you only have let out 50%. Now answering this, municipal value versus fair value, whichever is higher becomes 4,20,000. That 4,20,000 will be compared with your standard rent, which is 4 lakh rupees, and therefore your expected rent becomes 4 lakh rupees. But expected rent for 4 lakh is pertaining to the full property, which means per property 50% of that you only have an expected rent of 2 lakh rupees. Now, since your expected rent is 2 lakh rupees and your actual rent is 2,40,000, it's obvious that your gross annual value becomes 2,40,000, being whichever is higher. So therefore your 2,40,000 is your gross annual value. There's no information about your municipal taxes and also I'm going to hold that information. I'm going to check the balance information before I complete the answer. The rates and taxes now say that it includes a sum of 10,000 rupees as a municipal taxes paid for the house. It is a 10,000 rupees paid for the house. Now here is where the challenge is. This 10,000 rupees which is paid as a municipal taxes for the house obviously pertains to both the properties, which means the 50% of SOP along with the 50% of let out property, which means I can only charge 5,000 rupees as a deduction for my HP, which means this becomes 2,39,000 worth of NAV. Now the problem does not stop there. Since the rates and taxes have this 10,000 rupees as municipal taxes, which means this municipal taxes are not pertaining to business. Since it is not pertaining to business, this now has to be disallowed under your PGBP head. So the whole 10,000 gets disallowed under PGBP. Now, if you ask me, Rahul, is this the right adjustment? I would honestly say no. The reason is very simple. Like I told you, the balance 50% of the property was used for both residence and office. Now, since the balance property was used for residence and office, a portion of that municipal taxes do pertain to office, and so you should be eligible for the deduction. But unfortunately, they have not clarified how much of that 50% pertains to office and how much of it pertains to residence. With lack of information, I will assume everything is SOP, and so everything gets disallowed. But yes, please do ensure you provide a note around it. You will have to provide a note around it saying that the 50% of let out property has been moved to HP and so it has been disallowed, whereas the balance 50% assumed to be a part of SOP property and therefore it is disallowed. If you assume that it is fully pertaining to your office property, which means you are allowed for a deduction. This note alone would carry half a mark and would impress the examiner to say that you understood everything properly. If you have not written it, you might expect a fall of marks. Completing this, we are now going next. It comes and says that the interest expense represents the interest on capital borrowed from a nationalized bank for the construction of the house. You're trapped again. You have an interest on the property. The property is pertaining to HP and therefore whatever interest which is shown here should be disallowed. Again, like I said, should you disallow the whole interest? Maybe no, because there are some house pertaining to office also, but with lack of information you don't have that info and so you're going to disallow the whole interest. What is going to happen is you have the whole interest. It says that the construction was completed in 2010 and 11. Neither the loan nor the interest was paid till the due date of filing the return of income. Neither the loan nor the interest is paid by the due date of return of income. Since you have not repaid any principal repayment, ATC becomes not eligible for you. But when it comes to interest, please understand this interest is being moved out of your PGBP and being taken care in HP. Now, the provisions of PGBP might tell you that you have to take a loan and you need to repay by the due date of filing of return of income, but there are no such conditions when it comes to HP. With HP having no such conditions, the whole of the interest which is shown is allowed as a deduction for you, which means the 80,000 worth of interest showing in the screen is that 80,000 interest pertaining to the house, which means what you need to do is, again, you need to put the interest as 80,000 rupees and move it out of your PGBP. With this moving out of your PGBP, you have to come to your HP again and you will come and say in HP, first of all, give your 30% standard deduction and then allow for your interest on loan. You will come and say, Rahul, interest on loan has not been paid before due date of filing. Please don't worry about it. Interest on HP has no such conditions, which means the interest on loan of 40,000 rupees pertaining to the let out property will be allowed as a deduction, and you will also create a new SOP column where you will allow the extra 40,000. You will allow the extra 40,000 because the property was taken after 1999. It is for the purpose of construction and there is no such other conditions given to you. So the 40,000 does become eligible for deduction. With SOP being less than 40,000, your SOP becomes negative 40,000 and you have your 30% standard deduction. You can calculate this on your own. I don't have a problem with it. I'm not going to give you the final answers, but this is how the number will look like. All right. So this is what will find out your properties. This is how your HP will look like and your PGBP is sorted with that extent. Moving next. You have something called as based on the actual rent received for unit 1, Mr. Basan has debited 2,40,000 as notional rent for unit 2, which is used for profession. Basically, what is happening is Basan has come and said, sir, 50% of the property was let out and I'm receiving a rent of 2,40,000 on it. The balance 50% of the property I'm using for my business. Since I'm using it for my business, I'm assuming that my opportunity cost on this is 2,40,000, and so I have debited this 2,40,000 because it is pertaining to business. Now, is that a right assumption? Obviously no. Obviously no. You are using this property for your own. At the best, you could have charged depreciation on it, but you took a chance and you charged 2,40,000. I'm sorry, the 2,40,000 is not allowed as deduction for you, so the notional rent will be disallowed from your hands. Which means the rent notional nature will have to be disallowed from your PGBP. You cannot claim this as a deduction. Now here is where I get stuck. I'll tell you why. Please understand, the question somewhere came and clarified that the 50% of the property was charging a rent of 20,000 per month. And if Basin has taken a decision to charge the balance 2,40,000 fully to your business, I am assuming that Basin is taking an assumption that the whole of the property, which is 50% in SOP, is only used for business. Now, this is what I get as a first impression from the adjustment which is now noticed. But in that scenario, what would happen is everything you did on the top, the 5,000, the 10,000 which you disallowed, the 80,000 which you disallowed, everything becomes wrong because half of it is pertaining to business and you were eligible for deductions. But again, lack of information, too much of a complex information, and I don't know what the answer is. So, smart people would have sat and wasted time on this. They would have tried to make an assumption whether it is allowable, not allowable, business, non-business. Please don't worry about it. The question is vague as it could be. So don't worry about it. Even if you have taken everything as disallowed, you will still get marks. If you have taken 50% of disallowed, you will still get marks. Since the ICI is blank on this, ICI will give you weightage marks on both the cases with the proper assumption note. As long as you have put a clear assumption in the paper saying that this is pertaining only to business and this is pertaining only to profession, it will not be a challenge. You will be given the full marks on it as long as you provide your assumptions properly. So you will have to be careful about it. All right. Great. Moving forward. You have been informed that there is an expense on the insurance premium of 72,000, which is pertaining to a lump sum health insurance premium paid by Mr. Basin for 3 years. Which is effective from July 22 till June 2025. This has been taken for self, has been taken for the spouse, and has been taken for 2 dependent children. We are right now in 80D. Which comes and says that any kind of health insurance which has been taken for self, along with spouse, along with dependent children, can be claimed as a deduction under 80D. And unfortunately, since it is personal expenses and it is already debited into P&L, you will have to first disallow this out. So therefore, the insurance premium of 72,000 showing on the screen cannot be forming part of your PGBP income and therefore has to be disallowed from your PGBP income. But having disallowed this PGBP income, after you compute your gross total income, you can bring in an 80D. Now, the challenge here is, it says that the 80D pertaining is your 72,000 for 3 years. 72,000 for 3 years. And I know some of you would have made this mistake where they would have said, okay boss, it is pertaining to 3 years, so it is 72,000 divided by 3. Unfortunately, no. It is 72,000 pertaining to 4 years. Why, Rahul? The provisions of 80D come and clarify that if you have taken a medical insurance premium which is pertaining to a specific years, you need to divide it based on the number of previous years in which it is in force. And in this question, they have come and clarified that the policy is applicable from July 22, meaning it will start from July 22 and it will go till June 25. Now, because it is going till June 25, your July 22, your July 23, your July 24, and your April 25 also comes into picture, which means now you have to split it over 4 years. Since you're going to split it over 4 years, your 80D deduction will be split over 4 years, which means you will get about how much will you get? You'll get about, let me see quickly. Yeah, so you have 72,000, you will divide it by 4 years, which means you will get about 18,000 rupees. You'll get about 18,000 rupees. Now, because you are a person who's not elderly or a senior citizen, you will only get 80D worth 25,000. Since you have only paid 18,000, you will only get a deduction of 18,000. So you can claim your 80,000 and you can be happy with that. Any other question in the thing? No. It says that the insurance premium is paid by account paycheck. You have used the permissible mode, so therefore there is no problem around it. Next one, it says the expenses on personal professional fees includes a sum of 1 lakh, which is paid to Mr. Ronak, a resident Indian, on which no tax was deducted at source. You have paid a professional fees to someone who you forgot to deduct taxes on. Now, standard questions, standard adjustments, every time it comes in exam, you are looking at an adjustment where no TDS has been deducted. Since Ronak is a resident Indian and you have satisfied a turnover of 50 lakh rupees for the last year, you will have to deduct TDS on this, which you have forgot. So, unfortunately, you will be taking a disallowance of 30%. Taking a disallowance of 30%, you are under 40 AIA of 30%. Therefore, the disallowance amounts becomes 30,000 rupees. It becomes 30,000 rupees. And with this, we are moving forward. Yeah, great. It comes and says there was only one block containing computers which came into existence only on 2nd April 2022 when new laptops, printers and scanners were purchased. So the computers which you noticed on the top, there was a depreciation on computers. They have come and said that boss, this computers came into existence only from 2nd April 2022, which comprises of your laptops, comprises of your printers and scanners also. Comprises of your printers and scanners also. Now, if you notice, when it comes to computers, there is a case law which comes and clarifies that printers and scanners are also an integral component of computers and therefore will be eligible for the same rate. It will be eligible for the same rate. The problem really happened is where he came and he charged 60% depreciation on this. He has charged a depreciation at the rate of 60% on the entire cost of 2 lakh rupees and has debited the same to P&L account. Please understand, when it comes to computers, you are only eligible for 40% starting 2018 or 19 maybe, and so you could not have claimed 60%, you could have only claimed 40%. You have 2 lakhs worth of computers, you could claim 40% on it because it is put to use for more than 180 days, which means the number becomes 80,000. You have charged 1,20,000, which means you have charged 40,000 rupees extra. This becomes a disallowance under your PGBP as a differential cost. So add the additional depreciation which you have charged. When I say additional depreciation, I am not meaning the manufacturing sector one, I am meaning the over and above cost which you have charged, which you shouldn't have charged, So I am going to disallow 40,000 rupees worth of depreciation from your P&L statement. Great. Moving to the next one. Yeah, last one. It comes and says Mr. Basan has also taken a loan of 5 lakh rupees from a nationalized bank for the higher education of his son. During the previous year 22-23, he repaid a principal of 75,000 and interest of 40,000. Both the amounts are not reflecting in P&L account. Now, this is where you need to be careful. The amounts are not reflecting in P&L account and therefore no adjustment has to be made from PGBP. Then why is this thing given? We are in section 80E. We are in section 80E. This section 80E comes and says that if you have taken a loan for your higher educations, you will be eligible for the interest component on the loan taken, and therefore the principal will be ignored and the interest will be allowed as a deduction under 80E. So therefore you will move back to your paper and you will go to 80E and you will allow a deduction of I forgot the number, I'm sorry, 40,000. You will allow the deduction of 40,000. Now in this I do not see, do you have any interest? Yes, you had an interest of 25,000. You are a non-senior citizen, which means you'll also get an 80 TTA. You'll also get an 80 TTA, maximum of 10,000 rupees. Because you are a non-senior citizen, you can only claim up to a maximum of 10,000 rupees. This marks the end of your PGBP. So in PGBP, in a summary shortfall, you will find these items. You will start from a net profit. You will remove your 25,000. You will remove your 99,500. You will remove your rent of 2,40,000. Add back 10,000 of municipal taxes, 80,000 worth of interest, 2,40,000 worth of notional interest, 72,000 worth of insurance premium, 30,000 worth of disallowances, 40,000 worth of your extra depreciation, and you will arrive at your PGBP. Now you can find your numbers on your own. You will have a PGBP number here. Your salary number will be 2,50,000. Your HP number is what is on the right side, where you did 2,39,000 worth of NAV. You will have to give 30% standard deduction. Find out your LOP property. In that LOP property, you can allow your SOP losses and then you will arrive at the net HP. Coming to your other sources has a winnings which is worth 1 lakh rupees. You also have interest, right? Yes, you also have an interest worth 25,000 if my memory serves right. Yes, you also have an interest worth 25,000 rupees. So therefore your IFOS income will become 1,25,000 rupees. You have all the items of the heads in the 4 tables. You can add all the 4, you will get your gross total income. After you get your gross total income, you will have to claim your deductions worth 80D, 80E and 80 TTA. Please be extremely careful about one thing. whenever you're claiming your deductions under Chapter 6A, you cannot claim a deduction on winnings. So whenever you're computing a Chapter 6A, please verify that after you give your deductions, your gross total income should not fall below your winnings. If it ends up falling below your winnings, you cannot claim such Chapter 6A. You will have to restrict it to 18,000, which means you have to pay tax on the 18,000 no matter what. So if at all this question has a total income, gross total income where the amount is going lesser than 18,000, please to ensure that you minimum offer 18,000 as a total income. Keep a check balance on that. I have not calculated the answer, so I don't know much about it. And I think we are done with the question. Yes, you're required to compute the total income under the proper heads of taxes under the regular provisions, assuming he has not paid taxes under 115 BAC. You're also required to compute the taxes, so you will have to be careful about it. Please understand, whatever you do, you have to take your gross total income, you have to reduce your Chapter 6A, arrive at an income separately. Take your winnings and arrive at an income separately. These incomes will be taxable at slab rates, these incomes will be taxable at winnings. Winnings will have to be paid a tax on mandatory, no matter no exceptions. And the slab rates can be used for your basic exemption limit of 2,50,000. If at all your income is less than 5 lakh rupees, you will be eligible for a rebate, which I don't think is the case in this one, because your net profit itself was 39 lakhs. You would not be eligible for rebate, and so therefore a straightforward tax computations where you just have to ensure that your winnings are being taxed at 30%. That's all is what you need to do. A straightforward simple question, except for some adjustments pertaining to that house property and the 50% part. If you can answer the 50% part properly, I think the answer was quite straightforward. You didn't have much to worry about. But yes, what assumptions you made in that 50% can really make an impact on your answers. Careful about it. All right, great. This is what your 14-mark question look like. Let's move to the next question quickly so that we can answer the paper within time. Looking at question number 2, it comes and says that you are Mr. Jaychand. You're Mr. Jaychand, who is an Indian citizen, have left India for employment in the country X on 5th June 2014. Back in 2014, you left to India for employment but you are an Indian citizen. He has been regularly visiting India and has stayed for 60 days in every previous year since then. Now, every previous year you come to India, you stay for 60 days. The problem what happens is current year you would have stayed for, I think current year is already clarified. Okay. So it says, however, in the financial year 22-23, you did not come to India at all. Now, current year you have not even come to India for a single day. No matter what provisions you look for residential status, a bare minimum of 60 days is the criteria any case, no matter whatsoever. And here, unfortunately, you have not come for a single day, which means I can outright come and say that Jaychand is a NR. I can outright come and say that Jaychand is an NR as of now. As of now, please read the question further. It comes and says, he owns a commercial building in Delhi which is let out. He has also set up a retail store in India which is completely controlled by his brother from India. He provides the following information to you regarding the financial year of 22-23. From the commercial building in Delhi, he has received 12 lakh rupees as income. And from the retail store, he has received 4,50,000 as income. Okay, great. Adding both, it becomes almost about 16,50,000. It becomes 16,50,000. Country X does not have to tax any individual on their income as there is no personal tax regime there. Now, this is where the challenge is. You might be a non-resident, but since the question comes and says that you are not liable to tax in any other country, you now fall into the trap of deemed residency. And for you to satisfy the conditions of deemed residency, there are two things to be taken care of. Condition number 1 is that you should be an Indian citizen, which is there in the question. So you are an Indian citizen, so that's not a problem. And condition number 2 was that your income, assuming you are an RNOR, should be more than 15 lakhs. Looking at the question, I think income from commercial building is what he personally owned, and therefore this is income accrued in India. This will definitely be taxable regardless of your residential status. Coming to the retail store one, I think it looks like it is being controlled by the brother from India, which means it is a business controlled from India, and therefore it will be taxable for an RNOR. With it being taxable for an RNOR, this too becomes your Indian income, and adding both, it becomes more than 15 lakh rupees. With them becoming more than 15 lakh rupees, you are now a deemed resident. Satisfying the conditions of Indian citizen, having a total income more than 15 lakhs. You are required to determine the residency status of Mr. Jaychand for the assessment year 23-24. Like I said, you will become a deemed resident as long as you provide your notes properly. So you'll have to provide all the notes properly, clarifying that you have not stayed in India for any previous year in the current year, and therefore you are a non-resident. But because you do not become liable for tax in any other country and your Indian income becomes more than 15 lakhs, you now have to be treated as a deemed resident, and therefore your residential status becomes resident but not ordinary resident. What would be your answer if he is a citizen of country X? Okay, great. If Mr. Jaychand is found out to be a citizen of country X, the provisions will not apply because you need to be an Indian citizen for you to satisfy these conditions. Since you have not satisfied these conditions, you will not be treated as a resident, you will become a non-resident. And if you are a non-resident, your income will only be 12 lakhs. Your income will only be 12 lakhs. Your 4,50,000 will not be treated as an income because it is an income generating outside India. It's an income generating outside India. A straightforward, simple question, 4 marks, 3 marks. You just have to write the notes and you will get your answers properly. Moving to the next one. It says, Mr. Prashant is age 35 years, is an Australian citizen who settled in Australia and has visited for 125 days in every financial year since the last 5 years. Since the last 11 years, sorry. So you have been receiving, you have been there in India for 125 days in every financial year for the last 11 years. During the financial year 22-23, he has visited India for a total period of 200 days. Okay. So in the current year, you have been in India for 200 days, and because you have been in India for 200 days, you have to not check for any condition other than the fact that you have been more than 182 days, which means you are a ROR. Which means you are a ROR. Rahul, how did you decide you are an ROR? Very simple, people. Please understand. You are an Australian citizen, which means for you the second condition is also applicable, which means 60 plus 365 is also a criteria. 60 plus 365 is also a criteria. Now, while in the current year you might have been for 200 days, last year you would have been for 60 days, and overall every year you are being there for 125 days, meaning no matter how you try, you will end up being more than 365 days in any of the years. Which means last year also he would have been a resident, last year also he would have been a resident, prior to that also he would have been a resident. Now, for you to become an RNOR, you have to satisfy certain conditions. 2 conditions being you should have stayed in India for less than 730 days, which is not the case here. Which is not the case here. You would have been staying for more than 730 days in the last 7 years, and therefore that condition is not satisfied. Since you are going to satisfy 60 plus 365 in almost about every previous financial years, you will not be treated as an NR also for the 9 out of 10 years, and therefore you will be treated as an ROR. You will be treated as an ROR. Mr. Prashant in this question has ended up becoming an ROR. Let's look forward. During the financial year 22-23, he visited India for a total period of 200 days. The purpose of his visit was to meet his family members who has settled in India and is also managing his business in Sri Lanka throughout his office in Chennai. Now, all this information does not make sense at all, because please understand, they are trying to sway you away with the fact that he has come to India for a visit. It doesn't matter, people. You will only look at those conditions provided you had stayed for less than 182 days in the current year. Since you stayed for 200 days in the current year, you don't even have to worry about those provisions. You are directly a resident. Now, whether you come for stay, whether you come for permanent residence, it doesn't matter. You will be treated as a ROR. You will be treated as an ROR. Keeping that in mind, let's look at the question. It comes and says, during the financial year 22-23, you have been given the following information. Income from businesses Australia is controlled from Australia. It doesn't matter. You are an ROR, so everything becomes taxable. Income from business in Sri Lanka controlled from Chennai, it is fully taxable. Short-term capital gains on sale of shares of an Indian company received in Australia is 50,000 rupees. The shares were sold online from Australia. It doesn't matter. You are an ROR. Income from agriculture land in Australia received there and then brought into India. Income from agriculture land in Australia. Please understand, agriculture income becomes exempt from tax only if it is a land situated in India. Since it's a land situated in foreign, this also becomes taxable for you. This also becomes taxable for you. Adding all the 3, adding all the 4, I think it becomes 36 and 38 and 38 lakh 50,000. It becomes 38 lakh 50,000. So you are an ROR with an ROR having your total income of 38 lakh 50,000. Nothing else is given to you. No chapter 6A, no nothing. So therefore a straightforward 4-mark question, just calculating everything as ROR and taxing everything directly. You have a straightforward answer in front of you. Great. Coming to question number B, it comes and says, Mrs. Tara is a resident individual, age 32 years and a social media influencer. She has been making videos reviewing various electronic products and posts these videos on social media. On 1st December 2022, XYZ Limited, an Indian company, manufacturer of electronic cars, gave her a brand new car for having fair market value of 6 lakh rupees to promote on her social media page. She has been given a brand new car, 6 lakh rupees to promote on her social media page. I think I know where it's going, but let's wait. She used that car for 7 months for her personal purpose, recorded a video reviewing the car, and then returned the car to the company. You are required to discuss the applicable provisions in respect of Income Tax Act regarding the deduction of source. Very good. We are in TDS chapter. TDS chapter. If you notice what has happened, there is a free car given to a social media influencer for using and promoting. This is your amendment for the current year. We are in 194R. We are in 194R. Your amendment for the current year, which comes and says that, boss, if you have received any kind of benefits and perquisites during your business more than 20,000 rupees, you will be taxable for 194R. The person deducting the taxes should have a business turnover more than 1 crore. Should have a business turnover more than 1 crore. In the absence of information, we are assuming that XYZ Limited will have a turnover more than 1 crore. I'm sorry, it doesn't matter. The turnover of more than 1 crore is only applicable on individuals. This is the company, so the turnover should be more, or you don't have to worry about it, and therefore 194R will apply. 194R will apply. Since 194R is applying, you have to deduct TDS on this, but there is a circular on this. There is a circular on this, which is what they tested on this. The circular comes and says that if you are a social media influencer receiving any kind of benefits and perquisites, normally 194R will apply. Yes, but if it is noticed that you are using the product for the promotion and then giving back the product, you have basically given away your benefit after a certain point of time. If you have given away your benefit after a certain point of time, there is no point of me taxing you right now and then giving you the deduction later. So therefore they came and said TDS will not apply. TDS will not apply. Therefore, the simple substance of this question is that while it is a benefit and perquisite arising out of the business, unfortunately, since she has returned the car back to the owner, she will not be having any more benefits and perquisites, and therefore this provision will not apply. This provision will not apply. Straightforward. Next, Mrs. Aruna is a chief executive officer of a multinational company. She has hired Mr. Suresh for the supply of her housing stuff. Like gardener, chef and drivers, etc., and has made the following payments to him. Now. There is a person called Aruna who is a chief executive officer of a company, which means she is not a business person but rather a salaried person. She is a salaried person who has engaged someone for getting her some people. This is contract labor. We are in section 194M. Please understand, 194C would have applied as long as it would have been for a business purpose, or you would have had a business turnover. Unfortunately, you have a salaried individual and it is for a personal purpose. It will go under 194M. Now, since it is under 194M, you need to satisfy 50 lakhs worth of threshold limits along with 5% worth of TDS rates. So let's look at whether the amount is being satisfied. For the current year, you have made the following payments. You have made 25 lakhs worth of payment on 10th August, 30 lakhs worth of payment on 22nd November. Total of those become 55 lakhs. All conditions being satisfied, 55 lakhs is your total payment. You will have to multiply it at the rate of 5%, and that is the amount of tax to be deducted under section 194M. Would your answer be different if Mrs. Aruna is a businesswoman and her books are not audited in the immediately preceding financial year and the payment is for business purpose? Now. Notice this, no? It comes and says that you are a business person, meaning the salaried individual is gone, meaning now you have a business turnover. And it also clarifies that it is for business purpose. Now you might think that it is 194C, but unfortunately it continues to be 194M. The reason is because it comes and says that books are not audited. With the books are not being audited, it simply means that the turnover would be less than 1 crore. With the turnover being less than 1 crore, 194C cannot apply because the hijacker rules are not satisfied. So 194C cannot apply. With 194C not applying, you are now under 194M again. So would your answer change? No, your answer would not change. The answer remains same. You will still go under 194M with 55 lakhs multiplied by 5%. No change in the answer. Next, by virtue of an agreement with nationalized banks, Messrs. ABC Company Private Limited, a company engaged in catering business, has received 60,000 payment per month towards supply of food, water, snacks during the office hours in the employees of the bank. So what has happened? By virtue of agreement with nationalized bank, MS ABC Private Limited is a company engaged in catering business and has received 60,000 rupees for the supply of food, water, snacks, etc. during office hours for the employees of the bank. You are required to discuss the TDS implications on this transaction. You have two answers on this. One is that you will need to make an assumption that it is only supply of goods. If you're making an assumption that it is only supply of goods, 60,000 per month into 12 months will give you 7,20,000, and therefore 194Q will not apply. The second school of thought is coming and saying that, boss, these are catering services. Beyond giving the food and supply, this is more of a service nature, and so foods or works contract will be a part of 194C. You can make a choice on this. You will have to make your suitable assumptions to say whether you are looking at it as a service or are you looking at it as only a pure supply of goods. You're looking at as a pure supply of goods. You have a choice on this. If you choose to make it as 194Q, it becomes no TDS. If you choose to make it as 194C, then there is a TDS because the payment has exceeded more than 30,000 per month and 1 lakh rupees for the year. Now, since the payment is happening to ABC Private Limited, the TDS rate becomes 2%. So therefore, you will have to do 7,20,000 into 2%, provided you assume it as a 194C case. You assume it as a 194C case. If you assume it as a 194Q case, no TDS will apply on you. Make assumption. Great. Moving to the third question. Third question says, Mr. Bhagat is an individual aged 50 years, set up a unit in special economic zone for the financial year 17-18. You've set it up in 17-18. Let's look at where are you right now, right? You are in 17-18. Now 17-18 would have been year 1, which means year 2 would have been 18-19. Year 3 would have been 19-20. Year 4 would have been 20-21. Year 5 would have been 21-22. And you are in year 6. You are in year 6. 1, 2, 3, 4, 5, 6. You are in year 6. Now, the moment you are a SEZ unit having the 6th year of operation going on, you are eligible for 50% of the export turnover in your hand. You're eligible for 50% of the export turnover in your hand. Let's understand what has happened further. During the financial year 21-22, he set up a hospital in a district of Maharashtra with 110 beds for patients. Now, if you have set up a hospital with 100 beds or more, you will be now eligible for 35 AD. You will be eligible for 35 AD, and the question itself somewhere clarifies that you have fulfilled all the conditions of 35 AD. The capital expenditure in respect of the said hospital is given to you as 65 lakhs, which comprises of 15 lakhs worth of land and the balance for pertaining to buildings. So which means the question comes and says that you have incurred 65 lakhs worth of capital expenditure, out of which 15 lakhs pertains to land and the balance pertains to building. For those who have read 35 AD properly, you will realize that when it comes to land, land is not eligible for deduction, but the balance of the property is eligible for 100% of deduction. 100% of deduction. The hospital came into effect with effect from 1st April 2022, and the expenditure of 65 lakhs was capitalized in the books of accounts. Great. If you have capitalized the expenditure in books of accounts, you are now eligible for deductions only to the extent of the building. The relevant information is given to you as under. The profits of the unit in SEZ is given as 36 lakhs. The export sales of SEZ unit is given as 75 lakhs. The domestic sales of SEZ unit is given as 25 lakhs, and the profit from the hospital operations is given as 90 lakhs without claiming the 35 AD deduction. The question is asking you for computing the income tax under AMT and find out the AMT credit under the regular provisions of the Income Tax Act, ignoring the provisions of 115 BSC, and they've also asked you to ignore the marginal relief. They've also asked you to ignore the marginal relief. Now we have two kinds of incomes in this, so which means what we need to do is we need to first put out our PGBP income. We need to put out our PGBP income. If you notice in the question, the PGBP income would be what? The SEZ profit will be taken as is. The SEZ profit will be taken as is because no change will be happening in that. You will claim a deduction under 10AA. So let's keep it as is. Coming to the next one, you now have a 35 AD business. In that 35 AD business, your profits are 90 lakhs and you are now eligible for a deduction on the property. You're now eligible for a deduction on the property. Deduction on the property would be 65 lakhs minus 15 lakhs because 15 lakhs pertain to land. So therefore, you only get a deduction of 50 lakhs. And therefore, your business profit becomes 40 lakhs. Your business profit becomes 40 lakhs. You are adding the 40 lakhs to 36 lakhs. Your gross total income becomes 76 lakhs. With your gross total income becoming 76 lakhs, you are now eligible for 10AA deduction. 10AA deduction works on what model? You will have to take your profits from the undertaking multiplied by your export sales divided by your total sales. What is your total sales? 75 plus 25, therefore 100. So therefore, you will be eligible only for 1/3 of it. 1/3 meaning 12 lakhs. And therefore, your total income becomes 64 lakhs. Your total income becomes 64 lakhs. This is your total income as per normal provisions of the Act and is eligible for a normal tax rate. Now, as the person clarified, yes, you have told that he is Bhagat, an individual with an age 50 years, therefore every normal slab rate provisions will apply. But since it is 64 lakhs, you are now also eligible for, you are also now liable for surcharge. You are now also liable for surcharge. But somewhere in the question, they've also clarified they also want the AMT provisions to happen. So you will have to do the AMT provisions also. How do you do the AMT provisions? You take the total income and you arrive at the adjusted total income. So your total income becomes 64 lakhs. You will have to add back your 10AA because that is not an eligible deduction. So 12 lakhs will be added back. You will also have to add back your 35 AD deduction because that is also not eligible. So 40 lakhs will be added back, but I'm sorry, 50 lakhs will be added back. 50 lakhs is the deduction which you claim, so 50 lakhs will be added back. But yes, Income tax also clarifies that, boss, whenever you're creating your 35AD and you're assuming it as a normal business, you are now eligible for depreciation. You're now eligible for depreciation. Since the question comes and clarifies that 50 lakhs pertains to building, it means you'll be eligible for a 10% depreciation. So you can claim 5 lakhs worth of depreciation. You can claim 5 lakhs worth of depreciation. Adding all the 3 or 4 items, you have 64, 76, 126 and 121. You have 121 lakhs. This 121 lakhs will be eligible for 18.5% of taxes, whereas this will be eligible for slab rate model. This will be eligible for slab rate model. Compare the taxes, check whichever is higher. If your AMT becomes higher, you will pay taxes under AMT, but whatever is the difference will become your AMT credit. If your taxes under normal is higher, which does not look so in this case, you will pay taxes under normal and you will have no AMT credit. So compute taxes as per the calculators, find out what your AMT credit is, clarify the examiner that the difference of your tax under AMT and your difference of tax under normal will become your AMT credit, which has to be carried forward for a period of 15 years, Clarify all those provisions, you'll get full marks. Miss out something, some step marks will be lost. But yes, a quite straightforward question. Hey, 1 second. I think I have a mistake here. We missed out to do the 50%. Please understand you are in the 6th year of business, so therefore this becomes 6 lakhs. This becomes 6 lakhs. 76 lakhs becomes 70 lakhs. My bad, people. I'm sorry for that. You have 50% of deduction to be claimed. So therefore 10 lakhs will be added back. This becomes 70 lakhs. This becomes 70 lakhs. You will have to add back 6 lakh. Answer does not change for the AMT part. But answer is, this is how it is. Be careful about. Going forward, yeah. Mr. Rohan is retired from QRST Limited, a private sector company, on 31st March 2023 after completing 28 years and 3 months of service, and has received the following sums or gifts on retirement. We are now into salaries chapter. In the salaries chapter, they come and say that the gratuity which is received is 7,50,000 and is covered under the Payment of Gratuity Act. You have received a gratuity of 7,50,000 on retirement, so no problem about it. We'll have to do least of the 3. Going forward, it comes and says the leave encashment is 3,25,000 for 210 days leave balance in his account. He was credited with 30 days leave for each completed years of service. Leave encashment on retirement is also exempted for least of the 4. And then you have received a crockery set worth 4,500 from his employer at the farewell party, which was organized by the HR department a day before retirement. Now, this is where you need to take a chance. I have two things in mind. One is where you can make an assumption that the crockery set is a gift. If you tell that the crockery set is a gift given to you and the gift is given in kind for less than 5,000 rupees, this amount becomes not taxable. Option number 2, you can come and say this is a transfer of a movable property. Because it's a crockery set. You can say it is a transfer of movable property in which it is cost minus 10% depreciation SLM basis for the year of usage. Here the set does not say what and all you have used it for, so the whole cost becomes taxable. You will have to make a choice on this. My personal preference, call it as a gift, because if at all it was supposed to be a transfer of movable property, they would have come and clarified the number of years of usage. With no information given, this is as good as a gift given to you, and so this will be treated as a gift. If this is treated as a gift, the amount becomes not taxable. With the amount being not taxable, the question says you have drawn a basic salary of 25,000 per month along with 50% of basic salary forming part of dearness allowance. 50% of basic salary is dearness allowance, but not forming part of the retirement benefits. This is what the question comes and says. Now, with this much information, we can definitely compute your gratuity and leave encashment. Now, gratuity says least of the 4, so the first item is actual, which is 7,50,000. Next item is least of the 3. You have 20 lakh rupees. And the last item is, since you are covered under Gratuity Act, you have 15 by 26 into last drawn salary as per Payment of Gratuity Act into the number of completed years of service or rounded thereof. Now, number of completed years of services will be 28 years because you have 28 years and 3 months rounded off to 28 years. Now, coming to the number of salary, POGA Act comes and says, or the Payment of Gratuity Act comes and says, salary means basic plus all DA. It means basic plus all DA. Your basic salary is given as 25,000 per month. All DA will be 50%. So therefore, your total salary becomes 25,000 into 12, which is 3 lakh rupees, plus another 50%, which means 1,50,000. So therefore, it becomes 4,50,000. It becomes 4,50,000. So you will get 25,000 into 12 plus another 50%, it will become 4,50,000. 4,50,000 into 15 by 26 into 28 is what you'll have to do. Get least of the three, that will become an exemption for you. Balance will become taxable. Coming to the leave encashment is least of the four, so the least of the four will be 3,25,000. Point number B is your 3 lakh rupees. Point number C is your, what is your point number C, people? It is your average salary for the last 10 months. Now, in this question, I don't see the salary changing, so the average salary for the last 10 months will be the same. What you have to do is you have to take the average salary for the purpose of leave encashment means basic plus DA, forming part. In this question, there is no forming part, so you'll directly take your basic salary. Your basic salary is given as 25,000 per month, multiplied by 10, it becomes 2,50,000. It becomes 2,50,000. And point number D, it says your leave credit unutilized in month terms into average salary, The leave credit unutilized is your 210 days. 210 days will be put into month term, which is 30, which technically means 7, will be multiplied by 20,000 rupees. So therefore 7 into 20,000 will give you 1,40,000 rupees. So it is least of the four. Least of the four becomes 1,40,000 rupees. You have received a leave encashment of 3,25,000. You have got an exemption of 1,40,000. Balance becomes taxable. Moving forward, it comes and says, during the year, the employer provided him a motor car of 1,800 cc, which is used by him and his family solely for personal purpose. It is used solely for personal purpose. The cost of the fuel and repairs were met by Mr. Rohan himself. Rohan itself has taken care of his fuel and expenses, so therefore no benefit coming from the employer, nothing has to be taxed. The car was purchased by the employer on 1st April 2021 at the cost of 8 lakh rupees. Now, since the car is used for personal purpose and the car is owned by the employer, you will have to take 10% of the cost of the car as a perquisite, which means 80,000 becomes the cost of the car, which becomes a perquisite. The salary driver amounting to 10,000 per month was also met by employer only. Unfortunately, since the car is used for personal purpose, the whole of the salary which is paid to the driver will be treated as perquisite. No 900 rupees, because that is only applicable for official purpose and official part personal and part official. Since it is fully personal, you will have to take the whole of the cost of the driver as a taxable amount. 10,000 per month into 12 will become 1,20,000 rupees. Upon retirement, he gave the car back to the employer. Good for him. So therefore, the perquisite for the purpose of car will become 2 lakh rupees. You are required to compute the taxable salary of Mr. Rohan for the assessment year 23-24, assuming that he neither claims the relief under 89 nor does he claim 115 BAC. What you will need to do, you will need to calculate your basic salary being 3 lakh rupees, your DA becoming 1,50,000 rupees. Find out your gratuity quantum, find out your leave encashment taxable quantum. Your motor car becomes 2 lakh rupees. Find out your gross salary. In this gross salary, you will have to allow for standard deduction of 50,000 rupees and you will get your final salary income. A very simple question when it comes to salary. There were a lot of better complications which could have been given, but a very straightforward question given to you, an easy scoring mark as long as you keep your provisions intact. Can we go forward? Yes, great. I think this is the last question, but let's just check. Question number 4, it comes and says, Mr. Chaman is a 50-year-old guy and his wife, Mrs. Chaman, is 48 years old, has furnished the following information to you. All the amounts of income gains, losses are computed as per the Income Tax Act. My hunch, it looks like clubbing of income. So I'm going to create a column. I'm going to create a column called Mr. Chaman. I'm going to create a column called Mrs. Chaman. I'm going to answer all those provisions accordingly. Mr. Chaman's salary income is given as 11 lakh rupees. You will tax it under the head salaries for Mr. Chaman. Someone thinking, Rahul, should you give standard deduction or not? Please to understand, the question explicitly comes and tells that all incomes are as per the provisions of Income Tax Act, meaning the incomes are already computed. If you have taken a chance to allow 50,000 standard deduction, you will be losing marks regardless of the fact that you have given a note. It doesn't matter. When the question is explicitly clear of the fact that the provisions of income tax have been taken care of, you will not be given the deduction. You will not be given a marks for providing a deduction. Extremely careful about it. Next. Mrs. Chaman income from Kathak performance is given as 2,50,000. She is a professional Kathak singer, Kathak dancer, and has pursued dancing as a profession. A professional dancer, everything is intact, no problem with it. 2,50,000 becomes your business income. business income. Moving next, Mrs. Chaman earned long-term capital gains of 5,50,000 from sale of shares. No information given, assume it is 112A, 112. No information given, assume it is 112. No facts given about transfers and also no clubbing will also apply. 112 will become 5,50,000 for Mrs. Chaman. Next, Mrs. Chaman gifted 2 lakh rupees to Mr. Chaman out of her Sridhan on 1/4/2023. Mr. Chaman invested the entire amount in stock market but suffered a loss of short-term capital loss of 5,10,000 rupees. Now here is where some problem is there. Here is where some problem is there. Please understand, no? Look at the date. Look at the date. The date says 1st April 2023. The date says 1st April 2023. And here is where the problem happens. Here is where the problem happens. You are in previous year 22-23. With your previous year being 22-23, this is not a gift given in the current year. This is not a gift in the current year, which means gift would have been given in the next year. Short-term capital loss will pertain to next year. Taxability will also happen in the next year. So is this information relevant from exam perspective? No. If you look it on the face value, but my hunch, this is a wrong date. This is a wrong date. They assumed that the date should have been 22. My hunch is that they by mistakenly, instead of putting it as 23, they put it as 22, and therefore the problem, they instead of putting it as 22, they put it as 23, and therefore the problem has happened. On an assumption that it is 22, this would become taxable. The short-term capital loss which Mrs. Sridhan has, Mr. Chaman has earned, incurred, would be clubbed in the hands of Mrs. Chaman. Would be clubbed in the hands of Mrs. Chaman. Your choice, people. Your choice. You stick to the provisions and you come and say it says 1/4/2023 and therefore not taxable. Great. You will be given marks. If the assumption is made that the date is given wrong and you want to consider it, then also the marks will be given. A fallout from ICI perspective could become a challenge. Could become a challenge. How they will interpret is something which we will need to wait and watch. We'll need to wait and watch. But as such, you can make a choice. I'm making a choice that the date is wrong. I'm making a choice that the date is wrong because assume, no, it is a short-term capital loss. You have been given a long-term capital gain. They're trying to test a set of chapter for you. If they're trying to they're trying to test a set of chapter for you, assumption is that it has to be treated. It has to be treated. And so I'm making an assumption that it is 1st April 2022 and therefore I'm treating it as a short-term capital loss. Mrs. Naina, their minor daughter, has earned 3,56,000 by performing in various quiz competitions which were held online during the previous year, 22-23. Mrs. Naina, a minor child, has earned an income. Normally, clubbing provisions would apply, but unfortunately or fortunately, she has done it out of her skills and talents and therefore clubbing will not apply. This will become taxable under the head for Mrs. Naina. This will become taxable for Mrs. Naina. She kept the amount in a savings bank account and has earned an interest of 15,000 during the previous year, 22-23. Now this is where the change happens. While Mrs. Naina might have earned the income of 3,56,000 from her quiz and everything, the amount which is pertaining to the savings bank account is not out of her skills. Since that amount is not out of her skills, will become clubbed in the hands of the parent whose income is higher. If I'm looking at the question right now, it looks like Chaman's income becomes higher and therefore the interest on savings will become taxable in the hands of Mr. Chaman. Will become taxable in the hands of Mr. Chaman. So I'm going to tax that 15,000 rupees in the hands of Mr. Chaman and I'm going to leave it there. I'm going to leave it there. The balance income of Mrs. Naina will become taxable in the hands of Mrs. Naina. The 3,56,000 will become taxable in the hands of Mrs. Naina. Moving forward, it says Master Nilab, their minor son, second minor son they have, has earned second minor children they have, has earned an income of 35,000 from fixed deposit, which was made out of the cash which he received on his birthday from his friends and family. Now, on the face of it, if I notice, he has earned an income of 35,000 from an FD from a gift given to him, not out of skill or talent, so therefore it should be clubbed. But look at the question. It says, Mr. Neerab has suffered from disability as mentioned in ETU. The medical certificate shows a disability of 75%, meaning Mr. Neerab is a handicapped guy. With the handicapped children, you are not permitted for clubbing and therefore this 35,000 will become taxable in the hands of Neelab. Will become taxable in the hands of Neelab. The 3,56,000 will become taxable in the hands of Naina. So Neelab will become taxable for this. No clubbing is going to happen. You are required to compute the total income in the hands of Mr. and Mrs. Chaman and their minor children for the assessment year 23-24. You are required to ignore the provisions of 115 BAC. You are going to required to ignore the provisions of 115 BAC. Somewhere in the question they say it is also to be found out for minor children, which means I cannot just leave the question with Chaman and Mrs. Chaman. I will also have to create two more columns, one pertaining to Naina and one pertaining to Neelab. One pertaining to Naila, one pertaining to Neelab. Naina's income will become taxable for 3,56,000. You call it under PGBP, you call it under IFOS, it is her choice. It is her choice, it doesn't matter. Coming to Neelab, you've got an interest on FD. You've got an interest on FD, so that interest on FD will become taxable in the hands of Neelab. I think the number is 50,000. Oh, it's 35,000. The number will become taxable in the hands of Neelab. With the number becoming taxable in the hands of Neelab, this is what the provisions are. How do you complete the answer, Rahul? Please understand, people. For Chaman, your gross total income is 11,15,000. But the problem is, in this 11,15,000, you also have an interest on savings. You also have an interest on savings, meaning he will now be eligible for 80 TTA. He will now be eligible for 80 TTA of worth 10,000 rupees, and therefore it will become 11,05,000. For those who are thinking, Rahul, this 15,000 was clubbed from the person, so therefore no clubbing and all, no deduction will apply. It will apply. Please understand, 80 TTA comes and says if the income statement has an interest, you will be given a deduction. It doesn't matter where it is coming from. It doesn't matter where it is coming from. As long as the income statement has an interest, you will be given a deduction. Therefore, this amount will become deductible. Coming to Mrs. Chaman, you have 2,50,000 worth of PGBP. You have 5,50,000 worth of LTCG with a short term of 5,10,000. Short terms can be set off against long terms, and therefore your income will become 40,000, which means the income is 2,90,000. Your income is 2,90,000. Your Naina's income will become 3,56,000, and Neelab's income will become 35,000 because it is an FD. No deduction under 80 TTA or TTB will be given to you because it is a FD. Because it is an FD. This is how you will close your answer. These are your total incomes. These are your total incomes. Your income might be a little different than mine only for Mrs. Chaman. Only for Mrs. Chaman. To the extent you don't claim the 5,10,000, to that extent alone you will have a change in the income. Beyond that, there should be no difference. This is what your income should show from your statement. From your statement, there absolutely cannot be any change in the incomes for Chaman or for their children. Only a small change can happen with Mrs. Chaman, which you can take a choice on. I think a few more questions to go. Let's quickly complete it. It says, Mr. A is a resident individual aged 37 years, has given the following information with respect to various loans taken by him from a scheduled bank. He has taken a loan. From a scheduled bank. Let's understand the loans. He said that he has taken a housing loan of 36 lakhs on 15th March 2022 for the purchase of a house to be used for self-residence at the cost of 47 lakhs. The stamp duty value of the property is given as 42 lakhs at the time of the purchase. The amount of repayment of loan happening in the current year is 1,25,000 worth of principal, 3,65,000 worth of interest, and this is the first and the only residential house owned by Mr. Ray. They're asking you for all the deductions which are eligible, correct? Yeah, you're required to compute the amount of deductions eligible to Mr. Ray under the various provisions of income tax, which means they don't even just want chapter 6, they want everything else. Now notice, the first adjustment is a housing loan. Now the thing with the housing loan is that this loan was taken in 15th March 22. If the loan was taken last year, you had a provision last year of 80 EEA. Which permitted you an interest of 1,50,000 over and above the interest which you are claiming under HP. So if I have to look at the interest, what is the amount of deductions I will get? In 80 EEA, I will get an 1,50,000. Under HP, I will get 2 lakhs because it is an SOP property. So HP will give me 2 lakhs and 80C will also give me 1,25,000 because it's a repayment of housing loan. 1,25,000 can also be claimed under my HP. It can also be claimed under my, it can also be claimed under ATC. Right now, I'm not totaling it up because we have further adjustments. There could be some other ATC and your overall limit can fall. So I'm not totaling it up right now. Let's look at the balance information before we come back to this. All right, great. Point number 2 comes and says a vehicle loan of 16 lakhs was taken on 31st October 2021 for the purchase of electrical vehicles for personal use. Amount of repayment of loans are given to you as under. Principal, he paid 75,000. Interest, he paid 1,90,000. Now he's taken a vehicle loan on 31st October 21. This is your 80 EEB. With your 80 EEB, you are also eligible for a further deduction of 1,50,000 pertaining to your interest alone, which means the principal will be ignored. The interest will be taken up to a maximum of 1,50,000. The balance 40,000 will become ignored. Besides these loans, he has also paid a sum of 15,000 rupees to a political parties as contribution. The entire amount was paid in cash. Now, if you know GGB and GGC, the provisions would come and say that whenever you're making a contribution to a political party, the payment has to happen other than by cash, even for a single rupee. given for a single rupee. So this deduction will not be eligible. This deduction will not be eligible. With the deduction not being eligible, the question is pretty much done is what I see. It says you are required to compute the amount of deductions eligible for Mr. Ray under the various provisions of Income Tax Act so that he gets the maximum benefits, assuming he is not opting for 115 BSc. If he is not opting for 115 BSc, these are all your deductions. These are all your deductions. Please don't total them up. Please don't total them up because these are independent deductions pertaining to respective heads of income. It would not be wise for you to total it up and show it to them. It is enough if you show it as individual items, and that will solve your purpose. That will solve your purpose. But a very straightforward, simple question, nothing complicated about it. Great. Moving to the next one, it comes and says, what is the time limit within which an updated return can be filed? You are required to enumerate the circumstances in which updated return cannot be filed. A part of your amendment for your current attempt, while there were so many things to test in the amendment, they have only tested the theory part of it. What is the provision question? They are asking you for the time limit to file an updated return. You can file your updated return within 24 months from the end of your EY. You can file your updated return from the end of your AY. That is what the provisions of time limits are. What are the cases where you cannot file an updated return? There are some cases. I already told you in your exam, in your classes, the cases where you cannot file an updated return. First of all, it should be department friendly, meaning you should not end up in a scenario where you are not paying taxes. You're not paying taxes. So the cases where you cannot file an updated return, if the return is a loss return. If the return is a loss return. Second, if the return is a loss return and you are not moving to an income return. You're not moving to an income return, meaning if you had a loss earlier and you moved to a return of income where you have a profit now, because of which you will be ending up paying taxes, then you are eligible. Then you are eligible. Case number 3, if you have already filed an updated return in the past, no updated returns now. If you have already filed an updated return in the past, no updated returns now, and that's what the provisions are. That's what the provisions are. And the fourth provision comes and says, I don't know if it's there for inter or not, but the provisions are like that. They come and say that if you have been picked up for assessment, if you have been picked up for scrutinies and all those things, you will not be given an updated return opportunity. If you have been picked up for penalties, prosecutions, any kind of surveys, etc., you will not be given an updated return. I think it's a 4-mark question, 1 mark for your time limits and 3 marks for your balance. So 3 out of 4 should do. If you write 3 provisions, I think they should give you full marks. 4 should help you with an additional provision. 4 should help you with an additional provision. Beyond that, you're not supposed to write anything further. Don't waste time beyond it. Fortunately, the updated question or the amendment question is a part of OR. So let's read the second OR also. Let's read the second OR also. The second OR comes and says, a person other than a company or a firm who is otherwise not required to furnish a return needs to furnish return of income provided they satisfy certain conditions. Provided they satisfy certain conditions. They are right now in return filing chapter again. If you recall, I told you, return filing generally is applicable only for individuals and other persons provided you satisfy your basic exemption limit for your gross total income, ignoring your exemptions of capital gains. But beyond that, there were also additional conditions given to you in the syllabus or in circulars where they have come and said that regardless of whether the provisions are satisfied, you still have to file your returns. What are those cases? If you recall, the cases are like if you deposit more than 1 crore in a current bank account, deposit more than 50 lakhs in a savings bank account, go for a foreign trip for more than 2 lakh rupees, go for an electricity consumption of more than 1 lakh rupees. If you are having a business turnover, it should not be more than 60,000 rupees. Cases like that. And then you have something called as TDS, TCS also. If you are a person who is resident senior citizen having a TDS more than 40,000 rupees, not a senior citizen having TDS more than 10,000 rupees. If you are having bank accounts in foreign country for which you are the signing authority, or you have any assets in the foreign country for which you have a signing authority, you have to file a return. If you are a beneficiary of those cases, you have to file a return. If the beneficiary is filing, you do not have to file a return. Too many provisions. My recommendation, if you would have written the top one, you would have got full marks. Here is where you have too many provisions, too much English to write, and everything is important. They would not let you go with just 3 or 4 of it. You must have written everything, and then only you will got the 4 marks. So in this, if you would have chosen the top one, I think you would have made a smarter decision. But anyway, both the easy questions, both are theory, and that's it. With this, we are done with what is your income tax for your May 23 attempt. This is how the questions look like. After the analysis, I think you would have realized most of the questions were a part of syllabus. Everything was quite easy and quite straightforward. With no complications behind it, except for the fact that some places they missed a date, some places they did not give a proper clarification. To that extent, if you would have used your head and you would have done some adjustments, you might have some challenges in your marks. But beyond that, strictly speaking, the paper was quite easy. And if I really have to put a weightage to the assumption questions also, I could hardly put maximum 6 marks around it. Max to max 6 marks around it, which means 54 marks actually came from the syllabus and everything straightforward. Nothing complicated about it. You could have easily scored 50. I mean, yeah, I'm assuming your MCQs would have gone easy and you would have scored full marks in your MCQs, because that's what my first impression was when I heard from students. Even if we ignore the MCQs, out of 42 marks, 6 marks could be your assumption marks, where you could not have scored or you might have lost marks. So at best, you could have lost only 6 marks, which means 36 marks were still with you. Add another 18 marks from your DT MCQs. Maybe prudence concept, we are adding only 15. You would get 36 plus 15. You are already scored 51. You have already scored 51. And IDT also came quite easy this time. I am not the right person to discuss it, but what I understand from people is IDT also came quite easy this time. Score an easy 30, 40 marks paper. Could have easily scored 20, 25. Hard. I mean, no matter how you try, 20, 25 will easily come to you. 51 plus 20, 25, you're easily looking at around 75, 76 marks in this paper. And beautiful paper which could easily help you clear your group 1. And not just that, if you have taken the chance to go to group 2 this time, your group 2 set off will come very much from your paper of tax. Your paper of tax will help you with a huge amount of set offs in your group 2 also, helping you clear in both. That is the kind of paper which I notice right now. If you have done your accounts, you have done your costing properly, and you're very equipped for your group 2 properly, you are ready for your group 2, I think nothing can beat you from clearing this time and going to your finals. So take that thought in mind, have that kind of motivation and attempt your paper. If you're noticing this video after the paper, it's great. My only thought to you is stop worrying about what has happened. You've already done your paper. If you have really made some mistakes also, no worries. It's okay. ICI is favorable to you. It is not something which is going to fail you for these silly things. Don't focus on the 4 or 5 marks which you might have lost because of mistakes. Focus on the balance marks which is going to give you your exemptions or your ranks. Okay, focus on those, and then you will have a better life, better journey, no worries in life. That is what my signing off note will be. Stop worrying, people. You have done your best, leave the rest. That's what my final note is. Thank you, people. Have a wonderful day ahead, and see you soon in CA finals as you come forward to it. Take care, people.